Well, it's fair enough that this was a piece of news that attracted the market's attention on this Friday session. The CEO of one of the world's largest companies came out and stated that he believes there is a recession ahead. His company's share price tanked by over 20%, over $10 billion worth of market cap lost in one trading session. But it's more about what investors and analysts read between the lines through his company's earnings and also his forecast about where things may head that gives us an insight about where we're currently sitting. Of course, today we're going to talk about FedEx's collapse and why it matters, but we'll also talk about how it could potentially serve as a leading indicator in terms of global demand and economic activity. It attracted a lot of attention. It wasn't the only piece of news this past week. Yes, we all felt the pain, particularly on Tuesday's session. S&P 500 down by over 4%. Nasdaq, the growthier end of the market, down by over 5%. We're all feeling it. Of course, the inflation reading slightly hotter than anticipated at 8.3%. So I'd love to know your thoughts. Drop in a comment below. What have you made of it? Hopefully you enjoy a couple of days off this weekend to rest your mind. And we'll see what's up ahead with the impending Federal Reserve interest rate discussion not too far away. Before we get into the nuts and bolts of today's chat, if you're new here, make sure you subscribe, turn your bell notifications on, hit the like button. Plenty of videos on the channel for you. So we can see here, there was a range of different articles. The FedEx CEO stated that he believes that the company's strategies are a reflection of the global slowdown and that he also expects the economy to enter a worldwide recession. Accompanying this statement, there was some insights about whether this was serving as a canary in the coal mine. To understand that, we've got to understand where the phrase canary in the coal mine actually comes from. So canaries in the coal mine were, in the yesteryear, in a past generation, they took canaries in cages down into the mines to serve as a leading indicator or an insight into unsafe or dangerous conditions. Of course, this practice no longer goes on, but the statement has continued and been carried through this generation. And essentially, a canary in the coal mine is something whose sensitivity to adverse conditions, so negative conditions, makes it a useful early indicator of such conditions. And at its core, particularly in a market sense, it's something which warns of the coming greater danger or trouble by a deterioration in its health or welfare. And so there's a range of different sectors or proxies that market observers use as canaries in the coal mine. But the transportation index or the transportation stocks is one, because obviously transportation is at the core of almost all economic activity. Goods have to be transferred, people have to be moved around. Obviously products give you an insight into how much is being moved around, how much demand there is for individual products. And so transportation is at the core. And FedEx is obviously right at the crux and intertwined with so many different sectors as it helps move packages and a range of other things around the economy. So that's why FedEx's struggle was seen as a potential canary in the coal mine. And so that leads us to FedEx itself. So to understand why this discussion surrounding FedEx now attracted such attention and, fair to say, fear, we've got to wind our minds back about 3 months ago. So FedEx had an earnings call back end of June. So 3 months ago, really, it wasn't too far away. And to sum it up, the earnings call, there was solid results for the past period. There was bullish guidance. And in fact, they actually raised their dividend, which obviously is generally seen as a very productive and positive call from the company. We've pulled out some of those key insights here from that. It's quite a broad earnings call, obviously, so you can go back and look at it if you want. But essentially, some of the key ones, they stated outstanding results, testimony to Freight's continued focus on revenue quality and profitable share growth as FedEx builds on the strength as a leader in that market. Turning to FY23, projecting continued momentum with 9 to 19% EPS improvement. Obviously, quite a broad range, but solid EPS improvement either way. They expect margin expansion at all of the transportation segments to continue, and including enhanced revenue quality beyond inflation, technology-driven operational efficiency improvements, and increasing their utilization of their assets. It's worth noting that they projected fiscal 2023 capex as a percent of revenue to be under 7%, and they expected to repurchase an additional $1.5 billion worth of stock in the first half of fiscal 2023. And of course, that builds on the raised dividend, which, as we mentioned, is generally seen as a relatively bullish sign. And the comment at the bottom is fascinating. They stated they entered fiscal 2023 with a strong foundation for driving improved profitability and returns. So allow that to be really the framework that we think about, because that was only 3 months ago. With the guidance that they stated on this same earnings call, there was one analyst that asked, so obviously it sounds like there's some headwinds or normalization in economic forecasts. Yes, it's a wide range, but the upper end of that range is a nice acceleration in terms of earnings growth from what's been had in the past. And so they're stating, yes, there are some headwinds, but they want to square the body language around the economy being a bit softer, but the optimism internally about earnings power accelerating from where they are. And so the executive vice president and CFO, Mike Lenz, stated, cheers, he'll provide a bit of thinking around the range, but even though, yes, they're mindful of the conditions, it's a wide range, but they're confident that it's balanced and achievable outcome that they can navigate amid the uncertainty that's out there. And then the executive vice president, the EVP and chief marketing and communications officer stated that from a volume forecast perspective, they believe they were conservative in the range and the volume itself for the forecast. And this was for broader FY23. And then as they go through the year, the comps in the back half, especially from a domestic perspective, it's easier. So they've taken both kind of the economy into the consideration and the year on year. But for now, they feel pretty good about the range that they have. So of course, that's some more evidence that we're thinking about where they're positioned. And then just yesterday, this was what really attracted attention, was the FedEx CEO stated that he expects the economy to enter a worldwide recession. And this was accompanying some of their earnings and their numbers. But when he was asked directly by Jim Cramer about whether the economy is going to a worldwide recession, the CEO stated, I think so. But you know these numbers, they don't pretend very well. And obviously talking about their numbers themselves, he stated he's disappointed in the results they announced here. The headline really is a macro situation that they're facing. So really talking about the macro itself. The CEO, who assumed the position just earlier this year, said that weakening global shipment volumes drove FedEx's disappointing results. Now, while the company anticipated demand to increase after factories shuttered in China were to open back up, it actually fell. And so building on that, there was a bit more insight surrounding it. So week over week, it came down. The CEO of FedEx stated that the loss in volume was wide-reaching. The company's seen weekly decline since around its investor day in June, and that they're seeing the volume decline in almost every segment around the world. The weekly numbers are not looking good, and so at this point, the economic conditions are not good. And this is really interesting. This is why FedEx's results and insights matter, not just FedEx, but the broader transportation sector, because they are a reflection of everybody else's business. If people are selling more, if more packages are being dispersed out, if there's more economic activity, if business is booming, then especially in the high-value economy of the world, they'd expect to see that flow through FedEx and other companies. So we can see here, accompanying that, the company announced significant cost-cutting measures following what it called softness in global volume of shipments, and the company will close 90 offices and 5 corporate locations while putting a hiring deferment on it as well. And what was interesting was an MS analyst from Morgan Stanley, one of the investment banks, Ravi Shankar, stated the report could indicate a return to normal as pent-up demand from the pandemic waned. So that's heading back to the new normal. Where does that new normal land? We know we saw elevated demand and excitement during 2020, 2021, but where's that new normal land? And then Shankar wrote that the issue likely won't be transitory and that it could be the start of a post-pandemic unwind. And so the market reaction, where do we currently sit? As we can see here, the FedEx Corporation was down by over 20% on the day, around $10 billion plus of market cap lost. And this is a blue chip company. It's not a meme stock. It's not something flying up and down by 10, 20% on the day. This was a significant sell-off. We saw the EPS missed really, really heavily. $3.44 versus Street's consensus at $5.14. Revenue came in softer as well. And obviously building on top of that, FedEx withdrew the full year forecast that they just set in June previously. Now, if you are interested in the market positioning and what analysts think the markets will head and where the S&P 500 will head at the end of the year, we just did a video unpacking that. So I'll leave a link to that you can check out after this one. Make sure you've subscribed and turn your bell notifications on as well. Hit the like button, and most of all, drop in a comment. Let us know your thoughts on it all. It's a fascinating time on market. A big thank you for joining us. For now, stay well and happy investing.